Welcome to the Will Your Account Blow Up webinar, everybody. My name is Walter Peters, and as many of you know, we usually talk about naked Forex trading. Today we're going to go a little bit off track and talk about money management. But money management is probably one of the most important things in Forex trading, primarily because it's closely related to psychology, or what people sometimes call trading psychology. And all of this is interrelated, and one concept that keeps coming out when we talk about money management is the percentage at risk. Now, at the end of this webinar, I'd like to look at some of the charts so you can see some of the live trades that are available to us. But right now, what I want to do is talk about this idea of money management and trading psychology and how the two are related. Okay? Now, one of the things that a lot of people don't realize is that when we're talking about trading, our psychology directs more than we admit, for most of us, myself included. Most of us are not willing to admit how much psychology plays in our trading. Erwin says he bought the Naked Forex book. Brilliant. I hope you find it useful, Erwin. That's great. We often talk about some Naked Forex trading systems here at this webinar, but today we're going to concentrate on money management and why that's important. I fully expected that today we would see fewer traders here today than we normally do, simply because it's not such a sexy topic, money management. However, it is usually sort of the last piece for most traders to come into place. So if we look at traders and we talk about what is the normal progression for most traders, the first thing that we notice is trading systems, and that's the focus. The idea is that if we get the very best trading system, then everything's going to be fine. So our focus is on the trading system, and primarily on entries, right? Where do we get in a trade? How do we know when to take a trade? The second thing that comes in for most traders is exits, and that's this idea that how to take profit. Where is the most profit going to be made? And if you're not interested in trailing exits, that's usually where it starts to come in on that second stage. The third stage gets into money management. And the fourth and final stage for most traders is trading psychology. And there are very good reasons why 3 and 4 are last, and why 4 really follows 3. And the fifth stage really is related to the fourth stage, as is the third stage related to the fourth stage, but it's really about self-improvement. And this is where, if anyone's really serious about trading, they get into some sort of routine here that feeds back into their trading psychology, right? And so that's sort of the normal progression for most traders. I'm not saying that just because you're focusing on exits doesn't mean you're not going to be interested in trading psychology. All I'm saying is that this is the typical progression that I've seen in many, many dozens and dozens of traders. This is usually what happens. They usually first get interested in where do I take a trade, then get interested in how do I maximize my profit on these trades that I'm taking, then how do I maximize the profit that my account is making on these trades, and that's money management. Then, how do I, get my emotions right so I'm able to follow my rules? And finally, what can I do every day to keep me in the zone, in the trading zone, so that I'm following my rules, I'm happy, I'm confident, and all of that? So that's really what it comes down to. Are there any questions about that? About what I'm talking about here? Okay, so today what we're going to be focusing in is the 3, and to some degree number 4 as well. So that's really where we're going to be today. We're going to be at 3 and 4. Now, let's talk about what it means to be. You can see my spreadsheet here. Everyone wants to see my spreadsheet? Sweet, Ian, thanks. Thanks, Pan. Thank you, Maud. Okay, so what I want to talk about here is, does anybody have the numbers for their trading system? Now, you may be trading live. You may actually have, maybe you're not trading live. Maybe you've back tested in Forex Tester or something like that. Ian has been trying out the 2E system. Okay, does anybody have your numbers, like your win rate for a trading system that you're using? Do you know what your win rate is on the 2E, Ian? 58%. Brilliant. Okay. There, we'll plug in Ian's numbers. So Ian's been trading the 2E system, and this is a 58% win rate that Ian has. And so if Ian is taking a 2% at risk on each trade, now let's talk a little bit about this. If a trader is trading 2% risk, right, then then that's a start, right? Because what some traders do is they'll say, I'm just going to take 2 lots on every trade. So if I trade the euro pound, I take 2 lots, or if I trade the euro yen, I take 2 lots. Well, the problem with that, of course, is that even if I have the exact same stop loss, let's say I use a 50 pip stop loss on my euro pound and a 50 pip stop loss on my euro yen, the price per pip is different on both of those trades, and so what that means is I'm not risking the same percentage. So some trades are weighted more heavily than others. In this case, the euro pound would be weighted more heavily than the euro yen. Now, what that means is that I have more risk on the euro pound trade than I have on the euro yen. Regardless of what happens with the trade, I have more risk on that one than the other. So the way to do this, of course, is to calculate out your risk precisely, and that's not really what we're going to talk about today, but it is important to note that many traders simply use something across the board, like a 2 lots on every trade, or 5 lots on every trade, or a 60 pip stop loss on every trade, and that's fine, and you can do that if you use the pips. You know, if you say I'm going to use 20 pips on every trade, I'm going to use a 25 pip stop or a 95 pip stop, whatever it is, that's fine, but you have to adjust your lot sizes so that your risk is exactly the same. Now, if instead you use the same number of lots, then what's going to happen is you're not going to have the same amount at risk, because currency pairs vary in the price per pip. So some pairs cost more per pip fluctuation, and others, of course, cost less. So in this case, if Ian is risking 2% on each of his trades, we know, given this calculator, and by the way, if you guys want this, I'll send it to you happily. Just email me, walter@fxjake.com, and I'll send you this calculator, and you can get this risk of ruin calculator and get it for yourself and play around with it. There's another page that we're going to talk about in a minute right now, but for right now, the important thing to note is, if you know what your win rate is, and you know how much you want to risk on each trade, you will know what your risk of ruin is, okay? And the risk of ruin is less than 1% for Ian if you're taking 2% risk on every trade, given your 58% win rate. Yeah, Ian, email me and I can give you something even better than that, if you want it. So what this says is that my risk. Now, what happens if I bump this up to 5% at risk? What's going to happen to the risk of ruin here? Does everyone know what the risk of ruin is? The risk of ruin is essentially this idea that there's going to be a catastrophic loss in the account, and the account is going to be drained to basically to nothing. So a 97% loss of the account would be a risk of ruin, right? Essentially, you're going to run out of money. That's the risk of ruin. Pan on Fire says it's going to go up when we go to 5%. You're right. It's still less than 1%, and we're not seeing the number here. But if we move up to 10%, we actually have a 4% risk of ruin, don't we? So if Ian is risking 10% on every trade, he has essentially a 4 out of 100 chance of ruining his account and blowing it up. Obviously, if you go to 20%, now we've doubled from 10% to 20, but the risk of ruin didn't go from 4% to 8. I want you to notice that. It actually went to almost 20%. So we have basically a 1 in 5 chance of blowing up the account. That's not good, right? That's a bad idea. So what you'll notice is two things here. As you risk more per trade, the risk of ruin goes up, and as your win rate plummets, the risk of ruin goes up as well. Let's say that we have 25% on each trade. Now we're almost up to 30%, or almost a 1 in 3 chance. We almost have a 1 in 3 chance of blowing up our account because we're risking 25%. So this is something to keep in mind here. If you keep your risk low, then you're not going to make as much money, but you're also going to be able to live to trade another day and use that magical effect of compounding to grow your account. So this is very important here. What about 8%, let's say? It's starting to creep up. All right, now what happens if Ian tests his 2E trading system on another market? Let's say he uses it on, I don't know, the S&P 500, and he finds out that it only has a 49% win rate. Well, what will happen here is that risking, he's probably going to blow up his account. You can see it goes way up here, way up. So if it goes over 100%, it doesn't really make sense, and it's going to be tricky for you to understand this. But what you can do is go to the second page, and this is where you'll see where things make sense. This is actually a really good table on the second page of the spreadsheet. Again, if you want it, you can just email me, Walter@FXJake. I'm happy to send it to you. The idea here with this table is that you'll see graphically what happens, because actually the relationship on the first page is a little bit more complex than I gave you. It's a little bit more complex than that, and here's how. There's an interplay between the win rate, as we know, right, and the reward to risk ratio. I didn't actually plug in the reward to risk ratio in the other spreadsheet. It's a little bit simpler than that. But that's actually what happens here. So if we know, like Ian, the closest thing we had on Ian's was 60%, but we'll use 55% to be conservative. So if Ian has a 1-to-1 reward to risk ratio with a 55% win rate, I know it was a little bit better than that, Ian, but let's just say that you actually have a 55% win rate, not 58. Then with a 1-to-1, your reward to risk ratio with 1-to-1, so you're risking $1 to make $1 on your trades, you have a 13% risk of ruin, right? So it's better than 1 out of 10. That's not very good. What happens when this starts to bump up? 2-to-1. You go for $2 for every $1 at risk. If you have a 55% win rate, it plummets, right? And we definitely, to me, it's really worth it to have this percentage at around 1% or less. Really, I want to be trading, I'll show you where I want to be trading. I want to be trading in this area, or I want to be trading in this area, right? This is where I want to be trading, or even here, right? This is okay, but, you really want to be trading over here. So what happens to Ian, okay, if Ian has a 50% win rate? Let's say that we have a system that has a 50% win rate, and in our 50% win rate, we're going for 2-to-1 reward to risk ratio here. So I am going to go for $2 for every $1 at risk, right? So if I'm risking $2 for every $1 at risk, then I have a really good shot of not blowing up my account. 0.8, less than 1%. That's where I want to be. But what happens if I get a little bit itchy? What happens if, I'm risking, let's say I'm risking 50 pips on this system, and I'm going for 100 pips on every trade. And I win about half the time, about 50% of the time. I'm going to be going really well. But what happens if I start to take profit a little soon? Instead of going for the full 2-to-1 and the 100 pip target, what happens if I start creeping down and I start going for 75 pips or 69 pips or 78 pips, or I start closing these trades a little bit sooner before? What's going to happen to my risk of ruin? Well, you can't see it here on the chart, but I'm actually going to start moving over to here. And I'm actually going to start looking more like almost a sure bet to blow up. That's right, Mark. It's going to rocket up. Now, we don't have a 1.5 reward to risk ratio in here, but I'll show you how you can calculate it in a minute. This is very important because if we're not sticking to our system, if we're not going for the 2-to-1, right, what's going to happen is we're going to inch over from 0.8 into the 99 area. And we may not go straight to 99, which is almost a sure bet to blow up, but we might get to 55% or 60% risk of ruin, which I don't know about you, but I wouldn't want to coin flip my account. So that's something to think about here. Not only do we know that by reducing the amount that we risk, which is what this tells you about, this is what this is all about here, right? This is totally wrong. Not only is the percent at risk going to affect your risk to ruin, but also the reward to risk ratio. So if I start closing my trades before I should, if I start taking them off the table before I hit my profit target, while it might be nice to have a higher win rate, what's going to happen is I'm going to inadvertently expose my account to a very high probability of blowing up. It's very critical here because a lot of traders are living on this edge between here and here. It's something to keep in mind. Mark says, I've seen this before on the Daily Trader, but it gives me the willies every time I see it. Yeah, it's really true, and it's something that people don't think about. What Mark is saying is that you don't think that when you're trading a system, if it's got a 2-to-1 reward to risk ratio, you don't think that you're in trouble. You've got 2-to-1. Well, actually, if your win rate starts to fall and go below 40%, you are in trouble, right? Or if you've got a 50% win rate and you want to bump that up by taking profit off the table prematurely, what you're doing is you're moving closer to a 1-to-1 ratio, and you're moving closer to a surefire 100% or 99 out of 100% guarantee to blow up your account. So this is very critical, guys. I hope that you grasp what's going on here. I know for those of you that have been trading for a while, you can see clearly what's going on. But the take-home message is this. If I have a strict 2-to-1 reward to risk ratio, I'm better off taking the loss on the trade, waiting for the target, than I am to take early profit. Because if I take early profit, I don't know what trading system I'm trading. I'm somewhere in between these two columns. I'm not in this column anymore, and I'm inching toward this column. And that's a bad place to be, right? Jennings says, it's easy to say, but when the market starts taking back your profit, it's hard to hang in there. Yeah, and we're going to talk about this, Jennings. Yeah, that's exactly right, Edward. Edward says that's all psychology, and you're right about that. This is where psychology comes in, Jennings. You got it. Okay, so this is the spreadsheet that you can get if you email me, Walter@FXJake. Just ask for the risk of ruin spreadsheet, please. The risk of ruin spreadsheet, and I'll send that to you. Now, Edward is on track here. He's talking about risk tolerance threshold. That's where this comes in, Edward, the trading psychology part. So there's two parts of this. What most traders do, and certainly I was no different, when I first started trading, I focused on the reward, right? I wanted to know how much can I make. That's what I wanted to know. I didn't want to know about risk of ruin. I wanted to know how quickly could I ramp up my account. Okay? But instead, what I should have done is looked at the risk. How likely am I to blow up? The two are related, right? If I risk more, I might make more, and I might ramp up my account quickly, but my risk of blowing up also goes up, as we can see here. So what I want to do is I want to show you something. It's a really cool tool that you can use. One second, let me bring it up. Okay. You're going to see my page here. Yeah, Jennings says he likes the idea of it's better to take a losing trade than sacrifice your reward to risk ratio. It's true. If you go to fxjake.com/ruin, then what you're going to do is you're going to get redirected to a web page. It's not mine. So rather than giving you this link here, I just have a redirect. Now, this is the tool here that we're going to talk about, because this is where it all comes together, guys. This is really where we can pull it all home. All right. Jano says that from that table, one may assume that there is no trading system with a win rate higher than 60%. Yeah, good point. Basically, Jano, I mean, for me personally, I get about just under 70% with the big shadows, so around 69.8% or so. It hovers around there. So let's use that for example. Well, let's use the big shadows. So let's say that we have the big shadow trading system, which we know has a 69% win rate, or at least it does for me. And the win to loss ratio is essentially what we were talking about before, which is our reward to risk ratio. Okay? So I have a 69% probability of a win. And let's say that my win to loss ratio is at 1.3. So for every dollar at risk, I make $1.30. And let's say that I'm going to risk 1%. No, let's say I'm going to risk 2% per trade. And I'm going to look at over 1,000 trades, right? Now what I want to know is what's my risk of ruin or a drawdown? Let's just say risk of ruin, okay? You can see, essentially, I have no risk of ruin. As long as I keep trading this way, and as long as my win rate stays the same, and my win-to-loss ratio stays the same, and I keep risking 2%, there's really minimal chance of me blowing up my account. Now, if my win ratio changes, or my win-to-loss ratio, or the reward-to-risk ratio is what this really is, if that changes, or if I decide to get crazy and start, trading 15% on each trade, well, then my risk of ruin is going to start creeping up, right? So that's how this works. Is there any questions about this? Let me show you the other way that you can use this calculator. It's really cool. What you can do is you can go to drawdown, and you can say, what's the chance that I'm going to have a 30% drawdown if I risk 5% on every trade? I have a 1.3 reward to risk ratio, so I'm making $1.30 for every dollar at risk, and 69% of my trades are winners. So what is the risk of that drawdown? You can see I have a 30.1% risk, or 3 out of 10, roughly, as long as I keep trading at 5% per risk. So why would I want to look at a 30% drawdown here? Why is that important? Why don't I just look at the risk of ruin? Any ideas? Why on earth would I want to look at a 30% drawdown? Why is that important to me? Exactly, Mark. That's spot on, Mark. That's right. I just want to see if anyone else gets it. That's it, Mark. You got it. What Mark has said is that at 30%, you stop trading. And it's the psychological impact, and that's exactly right. So what I'm trying to get across here is that there's three things that are important here, guys. The first is how much are we risking, right? How much are we risking, and are we sticking to our system? Okay, the win rate is going to take care of itself. We'll get that from our back testing and Forex tester, or our live testing, or a demo, or forward testing with a demo account, whatever. That's going to take care of itself. We can't do much about that, okay? But what we can do is stick to our system and keep our win ratio, our win-loss reward to risk ratio true to our system, and not adjust our exits because we feel like it, or because we want to get out of a trade before the weekend, or whatever. That's the important thing here, is that we stick to our rules and we keep this true. And the other thing is that we don't start getting tricky and risking too much. And the last thing is what Mark has nailed on the head, and what I was asking for, which is basically this idea of the throwing in the towel point. When do we get to the point where we're going to throw in the towel? That's very different to risk of ruin. There are very few of us, and myself included, out there who will decide that you're going to trade a trading account and trade it into dust, right? Until it's just gone, until every last cent. You have a $200,000 trading account and you trade it down, and the last $400 is there, and you're going to keep trading it. That's not likely. What's more likely is that you're going to get a loss level. Maybe it's 40%. And then at 40%, you say, that's it, I'm done, throwing in the towel, right? So if I'm risking 2%, I've got a 69% win rate, and my win-loss ratio, or my reward to risk ratio is 1.3, then I have essentially a 0% chance of a 40% drawdown over 1,000 trades. Now, what if I say, well, you know what, that's not. What if I have a 25% drawdown? What if I say a 25% drawdown is, for me, enough to make me think it's over? I'm going to refresh this. Sometimes it gets stuck here and we have to refresh. I just want to make sure that I've got it. 2%, 1.3, 2% per trade, 69% win rate, 1,000 trades, risk of drawdown of 25%. And I don't have any chance of that. It's very, very low chance of that. It's not that I don't have any, it's that I have less than 0%. So less than 1%, so 0.5 or something like that, 0.3. What happens if I start creeping this up? What if I start trading 12% per risk? Of course it's going to go up, right? I'm guaranteed a 25% drawdown if I over 1,000 trades if I risk 12% per trade. So this is really critical, guys. I would encourage you to play around with this calculator. If you want it, you can go fxjake.com/ruin, and that will bring you here. Okay, fxjake.com/ruin. That will send you straight to this page, and you can play around with this. Does anybody have? Yeah, Jennings says, I lost 40% and quit for a year. Yeah, there you go. That's it. So that's what we're talking about here. So if we had a 40%, what was Ian's was 58%, right? Ian, do you know what your reward to risk ratio is for the 2E? Have you've tested it, or you've just started testing it? It's 1-to-1. Okay. In theory, it should be more because you have a trailing exit on there. So in theory, it should actually be more than that. But I mean, it'll only show up over time, right? So as you take more and more trades, Ian, it'll get higher and higher. It's sort of, you're capturing the fat tail. Let's say we risk 2%. We've got a 1-to-1, 58% win rate. We have a 1.2% chance of a 40% drawdown. Yeah, it may not work for everybody. Okay, Ian, I would, if it were me, Ian, I would definitely use the trailing exit. That's going to add to the alpha on this a lot. Yeah, exactly, Ian. Yeah, Ian's saying he's starting to appreciate the importance of a trailing stop. Pan on Fire says, "How is this for spooky? Your DVD just arrived on my desk. That's awesome." There's a Edward says, "Which DVD?" There's a DVD at FX Street you guys can get on Naked Forex that I did. It's a two. You know how FX Street has their DVDs? There's 2 DVDs set at FX Street and that's obviously available to all of you. So that's great. I hope you like it. I hope it's good for you. There's the link right there. Great. It's on there, so you guys have the link. Okay, so here we go. So Ian, what I want to show you this, Ian. Look what happens just when we go to 1.1. See how the risk went from 1.2% to 0? And that is just because, why? Because I applied a trailing exit to my system, and what happens then, it doesn't matter what system we're talking about here, but what happens is just by using that trailing exit and just ramping up the reward to risk ratio just slightly by 10%, it goes to virtually 0. John says for a $2,000 account blown to $250. Well, that's essentially an 88, isn't it? 87.5% blowout, I think, John. Here, 87.5. Okay, and what's your win rate? Do you know what your win rate is, John? Okay, let's say that John has a 55% win rate, and he has a one point for every dollar at risk, he makes $1.10. If he's risking 2% per trade over 1,000 trades, you have virtually no chance. I don't know what your win rate is and your reward risk ratio and all that. Essentially, you'd have to really ramp up your trades to get to that. See, now I'm risking 15% per trade, and I'm gonna get to that 87.5% blowout, right? Are there any questions about this? Does this make sense to everyone? I just wanted to get this through so that everyone can see. There's a couple of important take-homes here. One, if my trading system has a specific target or way of exiting, and I don't follow that, I'm going to put myself at risk for blowing up. Two, if I don't know what my throwing in the towel point is, then I'm probably going to be in trouble, right? If I don't know where I'm going to say, okay, that's it. If I lose 45% of my account or whatever it is, if I don't know what that number is, I'm going to be in big trouble. I have to know what that is in order for me to calculate, what I should be risking. I need to know that. I need to know what should I be risking based on what I'm trying to avoid. So there's two motivations in life. There's a motivation towards something, which in trading is profits and freedom, and there's motivation away from something, which in trading, of course, is drawdowns and ruins and emotional pain and all of that goes with that, right? So this is all about avoiding the pain, and the math that we use is very simple. I can send you that spreadsheet, but more importantly for you, you should understand the principles here, which are simply, one, if we risk too much, our risk of ruin goes up, our risk of a large drawdown goes up. Two, if we don't stick to our system, especially if it's a system with a high reward to risk ratio, we're also putting our account at risk, okay? I can point you, Mark, email me, I can point you in the right direction. There's basically a lot of, shall we say, if you want the exact formula, there's a lot of sort of controversy, or as our good friends in England say, controversy, over the calculations of that. But I can give it to you. Yeah. Okay. All right, guys. So that's it for now. I wanted to show you that. Now let's go to the chart, shall we? Let's bring up our charts and see what we have cooking. I can show you my favorite trades for the moment, which look just beautiful, and I'm very excited about these trades. So thanks, guys. Now let's go to. I've had some questions about the euro pound. I think this is not going to be a reversal. I know that it looks like a kangaroo tail, but I think it's on top of these highs here, and I think what you have here is a breakout with a retouch, and then it's going to go up. So I think it's going to blow through that. As for some of these pairs here, the euro kiwi, the pound kiwi, the pound Aussie, these are all looking just brilliant. I love the fact, basically, that the market fell through this floor here where these lows were, and then it just came back up and touched it right here. This, to me, is a great spot for a short. In fact, I'm going to take this like very soon. The high here is 62.76. So stop loss goes at 1.6280. This is my trade right here. I am going to take this trade. Yeah, it could go a little further, but I think this red candle has basically showed its hand. Let me show you why I like this as a sell pan. The reason why I like this is a couple of things. First of all, we know that it's in a downtrend. How do we know that it's in a downtrend? The reason we know it's in a downtrend is because whenever the big candles show up, they're red and they go down. And whenever the market decides to go up, it goes red and green. Red, green, red, green. Then it goes down. Then it goes green, red, green, green, red, 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 green, red. And then down. And now it goes green, 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 red, red, boom. So the low on this candle right here, what was the low? 61.65. What was the close on this candle? I believe it was lower. Yes. 61.63. So this candle closed 2 pips lower than the low of this candle, which to me, that's it. That's all I need to know. What I have here is a bend. The market broke through this level, it came back up, touched it, and now it's going to go. This to me is a great opportunity to sell the pound Aussie. Let's talk about targets. Let me back this up a bit. I mean, where we are right here is on top of this area, where this little jig was. This could be a brilliant fall all the way down to these top. I don't see any reason why it doesn't go to here, right? Let's just back it up. Let's actually go to the daily and see. We're on top of these highs here. I mean, this is really the first spot, but if you wanted to get tricky, if you really were worried, it would be this area too, at 59.70. Let me show you. So this is basically what I'm looking at here. I'm looking at a sell below. I could just sell right now, but actually I'm going to be a little bit conservative. I'm going to say I'll sell below this low at 61.38. 61.38 is my sell. Okay? 1.6138. That is my sell. My stop loss is at 62.80. My sell price is so in other words, the market must make a new low today below the low of this wick. The low is at 61.42, and I'm saying 4 pips lower, 61.38. And I'm going to target 59.75, which is right here. Just a little bit higher than that zone, just in case it brushes up against it. We actually recently had a really nice trade on the euro, and what happened was it took like 3 days for it to finally hit the target. And I'll show you that one on the weekly chart. 1 second. And then the next one is 58.90 basically. That's it. There it is right there. That is my pound Aussie sell trade right there. That's how I'm going to play this one. I could get in right now, right? I could do that, but it's a little bit safer just because we are on a zone here. It is a little bit safer to wait for the lower move. Black Cat says, how would the FOMC meeting minutes later on affect your timing of your trades? Basically, Black Cat, this is how I see it. I don't pay attention to it. Essentially, this is how it works. If I'm thinking about getting in a trade and I know that, for example, there's an interest rate announcement and that day, then I'll hold off. Likewise, if I'm looking at getting into a trade and I know that the non-farm payroll, is going to be released in 6 hours, okay, then I'll hold off. But anything else, and I just look at it as fuel. So, for example, last week, we actually traded the non-farm payroll, right? And my belief was that, let me show you. So here was the market marching upward. And my belief was that the market was going to fall, that this was a slow-moving uptrend, and that it would be punctuated by a big red candle. That, of course, that candle showed up right there. That was the non-farm payroll. And then I said, okay, it's going to start going down again. Now, it didn't go as far as I would like. It only went down here and double bottomed down there. But the point is that the big candles were in the direction of the trend, and the small little candles were going up. So that's kind of how I see this pound Aussie, in the same way, which is the little tiny candles that have closes near the middle, which don't really do much for me. These little tiny ones that are basically nothing candles, they're going up. And the ones that are of importance are the big red ones. So I believe that any news that comes out is more likely to push this pair down than up, simply because that's the direction of the trend. I'm not using any indicators to say that. I'm just saying that in essence, where we were in roughly a consolidating period here, certainly from this fall onward, we've been in a downtrend. From this kangaroo tail here onward, we've been in strong moves down with weak retracement, strong move, weak retracement, strong move, weak retracement. So I think that I'm in the direction of the power on the chart in essence by taking a sell here. So the long-winded answer to your question is I don't really pay attention to the FOMC minutes. The only two things that give me pause are when I know that an interest rate announcement is impending or the non-farm payroll. And other than that, I just kind of let it go. Yeah. Ian, I usually just use an order like this. See how the low on this candle was 42, 61.42, so I'm basically saying it needs to go 4 pips lower. Cool. No worries, Black Cat. Now, someone else had a great question here, which was Jason's. He said, your opinion, how high is too high with risk reward? I think what you're saying, Jason, is, is it acceptable to take like a system that's 5 to 1? I'm going for $5 for every $1. Let me just say that you really need to be strong in your psychology and be a very confident trader if you're doing something like that, even a 3 to 1, because what will typically happen is the win rate will come way down. Now, if you have a trading system that has an 80% win rate and you're getting 3 to 1 reward to risk ratio, then by all means go and trade it. But what's more likely to be the case is you're more likely to have something like a 40% win rate, or even a 35% win rate, and a 3 to 1 reward to risk ratio. So that's just something to keep in mind. because what that means is you're sitting through a lot of drawdowns, you're sitting through a lot of losing streaks, and you're waiting for the big, winner to come up. So the idea here, I guess what I'm getting at is the trading psychology comes into play here, and really knowing your system and back testing it and getting really confident in it. That's where you're going to get that's where you're going to be able to stick with it. Most traders aren't able to do that. You know what I mean? So it really depends on you. Let me just show you another one, guys. The reason why I like to use profit targets that are a little bit easier to achieve, the reason why I say that is because we recently had a trade here on the euro. Okay, this is a weekly trade that we've been talking about here. Basically, we had a bearish big shadow right here, which is a special case engulfing on the weekly euro chart. It broke lower. I sold at 30.53. My stop loss was above this big red candle. I moved it now to plus 10 pips, but it didn't hit 28. Look at last week. This is my first target. My second target is 26.90. Look at this candle here. That was last week's candle. It went to 28.05. The number's down here, right? It went to 28.05. So I missed my target by 5 pips. So usually my target is a little bit higher than my level. See, my level was at 27.95, my support level, and I put it at 28. I really should have had it at 28.05 or 28.10. I held on to it through this week's drawdown. It went as high as 28.97. So it came within 5 pips of my stop, and then it went 97 pips against me, or 92 pips against me. So, and then it finally cashed it out right here. So I'm riding it, and I'm waiting for this target right here. We had a similar setup on the pound, but that one hasn't actually hit both targets, so that one's all over. Same sort of bearish big shadow setup here on the weekly. So my point is that's why I'm using those targets on the pound Aussie, is because I want it to definitely hit that target. I think I have to go, guys. I think we're at the end of the show. But I just want to mention that we have similar setups to the pound Aussie. The euro Kiwi could get up to this 64.60 level and print a bearish candle. That would be great. There's another one here, I think, on the euro Aussie. That one just kind of tagged right here. These lows right here. So there's very similar setups here on other markets, but the pound Aussie is probably the nicest looking one. Jano, yeah, my sell stop is at 61.38. The way my colors work are blue price is the entry price, red price is the stop loss, and the green prices are my targets. So if you ever see one of my charts, it's really easy to know immediately. My entry price is this, my stop is this, and usually when it gets close to target 1, I'll move my stop down to break even or plus 5 pips or something like that. But in the beginning, of course, it's going to be up here above this wick. Yeah? I wish I had more time, guys, but I think we've got to go. Ooh, Ian's doing... excellent testing, Ian. That's great to hear. Thanks, DZ Bista. Thanks a lot, guys, for your time. I hope to see you next week. We will be here on Monday next week because I want to show you a very special trade that only occurs on Monday. So I hope to see you next week, guys. If you want any more information, you can attend next week, or you can get the DVD, or I'll see you in a couple of weeks. Thanks a lot. Thanks, Jay Trader. Thank you, Maud. I really appreciate it. Bye, Drew. See you, Forex Lady. Bye, Mish. Take care, Dia. Bye, Edward. Take care, everyone. Have a wonderful day. Bye.